All right, so as you gathered from your Pinnacle case, part 2, it was really dealing with the auditor looking at various client factors and then determining how that would impact the auditor's acceptable audit risk as well as inherent risk. And both of those are components of the audit risk model. And so we're going to talk a bit about the auditor's responsibility as it pertains to risk assessment, because the risk assessment is, again, a judgment process. So you notice that groups came up with different assessments in some cases with respect to the audit risk, and also with how certain components or events for Pinnacle impacted inherent risk, right? And the question was asked, is there a right or wrong answer? Well, it's a judgment call, because when you're making judgments, right, there's no standard that says we're going to all come to the same judgment, especially with these types of issues. So a big part of the audit risk model involves the auditor making assessments about various factors, and we'll talk about each of those factors. But the important thing with risk assessment, one, is that it's very clearly laid out in the standards in terms of how auditors, what types of procedures auditors should be doing to assess risk, such as some of the things we went over last week, understanding the client's business and industry. And then also importantly, it's not enough to just assess risk, you also have to respond to that risk. And so we have audit standards dealing with the response to risk. So AS number 12 deals with the risk assessment standards geared toward the audit being more effective, and auditor being more effective at assessing risk. And as a result of more effectively assessing risk, this should improve audit quality. And the way that it improves audit quality would be through the fact that the auditors have a better understanding of those things or issues with respect to the client that could impact the financial statements and or have a potential for material misstatement. So think about when you went through part 1 of the Pinnacle case. What you did was do trend analysis, and you did analytical procedures, current ratios, things like that. And you came up with, based on those findings from the trend analysis and the various ratio analyses that you performed, where there was a potential for material misstatement. And that was, in a sense, to guide you. So remember, analytical procedures during the preliminary stage or planning phase is attention directed. So where should you focus your attention? And the reason you're going to focus your attention there is because that's where there's the greatest risk of material misstatement. And so you want to collect audit evidence to reduce the audit risk associated with those things. So that's how we get to along the path of improving audit quality, but also how you respond to that. So yes, if you assess that there's a risk of material misstatement, potential misstatement, a higher risk of potential misstatement with respect to accounts receivable, and you don't adjust your audit procedures accordingly to address that risk, then you haven't achieved good audit quality, right? Audit quality is going to suffer. So AS 13 deals with how the types of procedures that auditors should perform in response to the risk that they assess. So I just want to point out, remember that the AS standards are AS number 12, AS number 13. Those are PCAOB standards. So they would impact publicly held companies. And as I pointed out earlier in the semester, that we're going to focus on where there's a difference in the AICPA or Auditing Standards Board and PCAOB, we're going to focus on PCAOB because our focus is going to be from a public company perspective. So where the standards differ, I'll refer to the PCAOB standards. So again, this just highlights the importance of the risk assessment process. In terms of identifying and assessing risk, the standards say that the auditor should perform risk assessment procedures. So we saw some of those procedures in the first part of the Pinnacle case. We saw where you did trend analysis, you computed various ratios and analyzed those ratios, and you looked at that in comparison to what happened in the previous year, what you knew about what was going on in the industry. You assessed the client's business risk and noted that they were bringing in a new company, solar, right? And the thought process was it's a new industry for them. They might not have the management expertise. The company's not doing as well. So that could have an impact on the financial statements. So that's all a part of, that's what AS12 was getting at, getting to understand, what is going on with your client, performing those procedures to be able to assess the risk of material misstatement, or whether it's due to errors or fraud. And when we talk about fraud in Chapter 11, we'll talk about SAS 99, which really gets to the auditor's responsibility with respect to fraud. The risk assessment procedures also say that, the auditor has to make sure that they have a really good understanding of not only the internal factors or the company's specific factors, but also external factors such as the industry, such as what's going on in the economy and how that impacts the client. So it's all encompassing, right? It's not just looking at the client as a standalone, but considering other factors that impact the client. And the reason we do this again is because if you don't do a good job of assessing the risk, and we'll see this when we kind of walk through the audit risk model, then you're not going to develop the right or design the right audit approach. So you're not going to collect the right amount of audit evidence if you do an ineffective job of assessing risk. And it goes both ways. Because if you assess risk too high, right? What's going to happen is, and you assess risk too high, and it's not reflective of the true risk, audit risk. Then what happens is you're going to do more work. So you're going to engage in more audit effort, and there's a cost to it. Remember, there's a cost to collecting evidence. And so you're not doing an efficient audit. Also, if you're doing work, if you assess the risk ineffectively, you might not focus on where the real risk is. So you might not devote enough time to those areas where there really is a greater risk of misstatement. And so your audit effort is spent on the wrong thing. And that's costly, both in terms of dollars, but also costly to the auditor in terms of reputation if, because of those ineffective risk assessment procedures, they miss something, and there is a misstatement that they don't catch. Materiality and risk are related. And so remember how audit risk is defined. It's defined as, the auditor giving a clean opinion, and in fact there is a material misstatement. Right? Because what they're giving an opinion on is that the financial statements are free of material misstatements. Right? So the higher the audit risk, the lower the materiality level assessed by the auditor. So let's think about that for a minute. The higher the audit risk, the lower the materiality level assessed by the auditor. Does that make sense? Think about what we know about materiality and the audit risk and why that makes sense, if it does to you. Yes, Natasha. I'm sorry, say that if audit risk is... Right, exactly. Right. So what, did everyone hear Natasha? She has such a soft voice, but she's absolutely right. So if the risk to the auditor is high, right, then they are going to want to collect more evidence because they want to keep that risk low. The goal is to keep the risk low, and that's what we're manipulating. I hate to say the word manipulate. That's what we're calculating or assessing with the audit risk model. The goal for the auditor is to keep that risk low to medium, because high risk means that they're running a higher risk of issuing incorrect financial statements. So if there's audit risk is high, they want to set the materiality limit lower, right? So they're saying, because think of what materiality means. That means that anything over this threshold is considered material to a user. So that means that the auditor is going to want the client to book any adjustment over that. So if they think, so by setting the materiality limit lower, level low, right, that sets a higher bar, right? That means that there are going to be more things possibly that the auditor would cause the client to book or require the client to book. Does that make sense to everyone? Yes, Oscar. No, that's the auditor's risk. Yeah. Because it has no effect, because that risk affects the auditor, right? And I doubt an auditor is going to go into, a client and say, oh, I'm willing to accept medium risk, right? Because then, again, it goes back to what we said about materiality, that the auditor is not going to disclose what materiality is, because then the client is going to try to, make sure everything falls under that limit, right? Where same thing with us, like, if they're willing to accept more, we can get away with more. We know that auditors, because we're only providing reasonable assurance, you can't look at 100% of the things, inherently you're going to accept some risk. The only way you're going to accept some risk. Also, it's not your financial statement, it's the client's financial statement. The client's engaged in the transactions, right? Because there are estimates built in to the financial statements through obsolescence, through allowance, warranty reserves, right? Because of those things, there's no 100% certainty about any transaction of that type. So inherently, an auditor accepts some risk. And the point of the audit risk model and assessing the risk, I should say, is that you want to try to keep that risk low. You know you're going to accept some risk, but you want to keep it low. So that's why it's important to effectively assess the risk and then have a proper response to that risk. And that's how the audit risk model comes into play. So the audit risk model is used for planning purposes, and I'll explain. So there are 4 components to it, and one component is plan detection risk. And the plan detection risk is how well, given your audit procedures, what's the risk that your audit procedures will not detect a misstatement. And we talked about acceptable audit risk. The inherent risks are the things that you saw some of the situations. Again, these are client risk factors, industry risk factors that impact the client, macro risk factors. And then control risk would be the risk associated with the client's internal control environment. So the risk that the client's control environment or control procedures won't prevent or detect errors or fraud. The audit risk model is an assessment. It's a planning tool. And you'll see when we go through each of the components, 2 of these components that drive the risk of material misstatement, which is inherent risk and control risk, the auditor can only assess. There's no certainty associated with those. And a key thing about it as well, what I want to get to, is the fact that it is based on the auditor judgment. So it's only as good as the auditor's input into this and the auditor's judgment. So it's only going to be as good as the auditor is at effectively assessing inherent risk or identifying those things that impact inherent risk, or again, effectively assessing control risk. Okay, so plan detection risk is the risk that your audit evidence will fail to detect a material misstatement. Because you are using your assessment of inherent risk and control risk to determine the amount of evidence that you're going to collect, right? And that's why we consider the risk of material misstatement to be a combination of inherent risk and control risk, because these are driving your evidence collection procedures. So, or the amount of evidence, I should say, that you're collecting. Then it determines the amount of substantive testing. So clearly, there would be an inverse relationship, right? So the lower your plan detection risk, so you want to keep that risk low, the greater the amount of evidence you're going to collect. Because you want to ensure that you collect enough evidence to be able to ensure that or be able to, or keep the risk low that you will miss or you won't detect a material misstatement. Inherent risk is based on the auditor's expectations or predictions, right? And you saw that in your Pinnacle Part 2. You went through those situations and you thought about or made a judgment about how that would impact inherent risk. And that is exactly what the auditor does. And this is the information that they collect during the planning phase of the audit as they're gaining an understanding of the client and the industry and the situations that impact the client's business risk. Here you're trying to assess the likelihood that there are material misstatements before considering internal controls. And so what kinds of things you thought about management integrity? The fact that there's a high turnover in the Pinnacle case. Many of you said the fact that there's a high turnover in the internal audit department at higher levels increases inherent risk. Because your thought process was, okay, is there a problem? Is there a problem with internal audit in that they're losing people? Is management not supportive of internal audit? Are they trying to suppress negative internal audit reports by firing these people or by forcing them out? What is going on? So is this an indication that there are problems with the company? Another thing you pointed out was the fact that increased inherent risk is that they were taking on a lot of debt, right? Or that, solar was another example where you thought it increased inherent risk. The fact that they had people doing, employees performing construction work because they were idle, because this was a non-routine type of transaction or an event for the company. There could be labor laws associated with having the employees, or what if somebody got hurt because they're not qualified to do construction work? It increases litigation for the company. So those, again, are all of the predictions or assessments that auditors are looking at. So they're considering how those things could impact the financial statements irrespective of internal controls. It's based on discussions with management, the company's, the auditor's prior knowledge of the company, if it's a continuing client, the results of prior audits, and it's inversely related to detection risk, and there's a direct relationship to evidence. So the higher your inherent risk, the greater your evidence, the lower your plan detection risk, right? Because you want to keep plan detection risk low. So that's inherent risk. And then we have control risk. And so this, again, is based on the auditor's assessment or prediction about controls given their understanding of the client's internal control procedures. So remember, at this point, assuming that this is a new client, you haven't really done, as an auditor in your planning phase, any internal control testing. This is based on your discussions with management. And we'll see next week when we talk about Chapter 10 the process that auditors go through to audit internal controls. So this is an assessment of whether misstatements will be prevented or detected by internal controls. Again, with SOX placed a high importance on internal controls, both from the auditor's perspective and from the client management. So both the auditors and the client management have to sign off, issue a report on the internal controls, that they have an effective internal control environment, that they take responsibility for internal controls, and auditors have to audit for publicly held companies internal controls in conjunction with the financial statement audit. So it places a lot more importance on internal control environment in an organization. There's a close relationship between controls and inherent, and that's what I said is the risk of material misstatements. Together, those two risks represent the risk of material misstatements. The higher the more effective your internal controls, the more likely that you have a well-managed company. So you reduce the risk of material misstatements, right? So effective internal controls reduces the likelihood of material misstatements. The risk between control risk and plan detection risk is inverse, right? So the higher your control risk, the lower your plan detection risk, the greater your evidence. So if you cannot rely on internal controls as an auditor, you're going to collect more evidence. So you're going to perform more substantive testing. So you're going to look at more transactions. You're going to look at more sales, more expenses. You're sampling, instead of sampling 100 items, you might sample 1,000 items. I'm just throwing out numbers. But your numbers, the amount of evidence you collect will be greater. And then we already talked about acceptable audit risk. So it's how willing is the auditor to accept that the financial statements may be materially misstated after the audit has been completed and the report issued. Right? There's a direct relationship between acceptable audit risk and detection risk, and an inverse relationship to evidence. So the lower your acceptable audit risk, the lower your plan detection risk, and the greater your evidence. In other words, you want to keep audit risk low, you need to collect more evidence. You're going to have greater evidence collection, right? And that increases the chance that you will, that your evidence, your detection, because that's what you're trying to detect, any material mistake, that increases your chances of detecting any material misstatements by collecting more evidence. Audit risk model, extremely important. It's important to understand the relationship, because this is highlighted in the standards, talked about in the standards, both PCLB and AICPA Auditing Standards Board, about the importance of the audit risk model and the auditor's risk assessment approach, and also in terms of direction, in terms of the amount of evidence that they collect. So any questions thus far on the relationship between these components and or any of the components independently? Okay. Okay. So I talked about the audit risk model is a planning tool, and it's not static, right? Because the one thing is you do gain additional information as you start to collect evidence. So let's take, for example, you might assess, based on your understanding, control risk as low or medium, right? Based on your understanding and discussions with the client. And then as you go through the process of assessing controls, or testing controls, I should say, you find out that there's an error, or you find out that there was a change made, in the control environment that has a pervasive negative impact. So now, all of a sudden, control risk goes from low to medium to high. And so now you have to adjust, right? You have to now collect. That changes your evidence collection. So you're going to do more substantive testing. You're not going to rely on those controls, because if they're not working, you can't rely on them. That doesn't mean you can't audit. That just means you change your audit approach to more of a substantive audit approach. Okay. So it isn't static, the audit risk model. But essentially, what you're doing is, as you're developing your predictions or your expectations about inherent risk and control risk based on what you learn at this point in the planning phase, understanding your client's business and assessing what your client's business risk is. Based on those inputs, you're assessing the risk of material misstatement, which is a combination of inherent risk and control risk. So that's how the audit risk model relates to the planning process. And as I pointed out, again, it's not static, because as you gain information during the evidence collection phase of the audit process, you refine your assessments or your predictions. Any questions so far? Okay, so assessing the risk of material misstatements due to error or fraud. So errors, as you know, are unintentional. People made a mistake. Whereas fraud is intentional. So it could be a misappropriation of assets, or stealing inventory, stealing cash, or fraudulent financial reporting that involves management massaging or managing the numbers to achieve a desired outcome. So some examples of misstatements would be an inaccuracy in the gathering or processing of data, difference between the amount reported in the financial statements versus what's been reported under GAAP. And that could be an error. The client might have interpreted the standards incorrectly. Might not be anything to do with earnings management. The omission of a financial statement element, account, or item. Incorrect accounting estimates because of misinterpretation of facts, or the omission of information that should be disclosed. So what an auditor has to do is determine whether or not this is really is it an error, or is management trying to fraudulently report information in the financial statements. That's a judgment the auditor has to make. I already said errors are unintentional. And usually they relate to things such as the gathering and processing of financial data, unreasonable accounting estimates because there's an oversight or a misinterpretation. Whereas fraud involves the intentional misstatements, and we're going to get into a lot more detail about the fraud in a couple of weeks. But the key here is there's a framework that guides the auditor in terms of evaluating fraud, or being able to assess whether there's a high risk of fraud. Because remember, auditors are not conducting a fraud audit. That's not the purpose of the financial statement audit. But SAS 99, which we will talk about later, does have some very detailed guidance for auditors with respect to conducting the audit and considering the risk of fraud in their audit process. So fraud involves intentional misstatements. The fraud risk identification process includes communications amongst the audit team. So for example, SAS 99 requires that the entire audit team get together and brainstorm based on everyone's respective knowledge of the company, brainstorm where there might be a high risk of fraud, right? What accounts, what areas, what factors drive that? And the importance there is because you are an audit team, you're doing one part of it, someone else is doing another part of it. The goal here is to share information, because the more information you have, you get a better, more complete picture. Talking to management, looking at fraud risk factors, which we'll talk about when we talk about chapter and get to that chapter, analytical procedures, as well as other information. There's in evaluating fraud, there is because again we're focusing on whether or not a misstatement is due to a fraud. There's what we call a fraud triangle. Has anyone heard of the fraud triangle before? Okay, so the fraud triangle is sort of like a framework to help auditors think through the risk of fraudulent or factors that would result in a higher risk of fraudulent transactions in the company. And it's broken down into three categories. One's incentives pressure, the other is opportunity, and the other is rationalization. So three. It's called a fraud triangle. So fraudulent reporting risk factors relating to incentive and pressure includes things like excessive pressure from management to meet third-party expectations. So this is when, and think about some of these things, you're collecting this information as you're thinking, going through the understanding the client's business, assessing management's integrity. So if management has high expectations of their employees to meet earnings forecasts. So the analysts have forecasted, EPS of X dollars, and we have to meet that at all costs. We've released information about our projected net income or revenue for the year. We have to meet that. I don't care what you do, we have to come to that number. If there's that kind of pressure, that should raise the red flag from fraud, potentially fraudulent reporting, and that should raise the red flag, so you're going to look and scrutinize revenue in a lot more detail if those red flags weren't there. Okay, so if management has, executive compensation tied to income or how well the company does, right? So, and that is an incentive for them to increase their own personal wealth. So you'll be concerned about fraudulent financial reporting. The financial stability or profitability is threatened. We saw with Pinnacle, one of the things, and I think a couple of groups indicated this, well, the fact that they are below the debt covenant current ratio 2.0 might give management incentive to try to manage the numbers because the cost to them or consequence to them of violating that debt covenant is that the loan will be recalled. Management's personal situation is threatened, and I talked about bonus, that their compensation is tied to the company's, how well the company's doing. The other part of that, the other second leg of the triangle is opportunities. So the nature of the industry. Is it a complex industry where they have complex transactions? So think about the fact that manufacturing could be pretty straightforward. Most challenging is you have to understand cost accounting, right? But it's pretty straightforward, calculating variances. But let's take a company that is financial services, where they have a lot of assets that require fair value accounting. And it requires fair value accounting, and there's no ready market to be able to assess that fair value accounting, the fair value of the asset. And so management relies a lot on models to come up with a fair value. Well, that's a lot more complex, and that's a lot more estimation, right? So that leaves a lot more there's a lot of room to be potentially to manage those numbers, right? Same thing, think about something like obsolescence or allowance for doubtful accounts. There's room to manage numbers within that. Not as complex as fair value, but there's still accounting estimates create this opportunity for fraudulent financial reporting. Is it a complex or unstable organizational structure? Is there a lot of turnover? Is there the type of person at the top who's very authoritative and demanding? And who does not allow for people to have a voice or an opinion. Ineffective monitoring of management. So here's again, what kind of governance structure is there? Is it an audit committee that exists only in form but not in substance? So yes, they meet the guidelines, but they don't really do anything. They don't hold a management accountable. They're not really taking an active role, oversight role in the financial reporting process. And obviously, if you have ineffective internal controls, that creates huge opportunities for fraudulent financial reporting. And then finally, the last leg of it is attitudes and rationalization. So what's the tone at the top? What message is management sending to its employees? Are they telling their salespeople, go out and sell, 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 sell? We don't really care as long as you get it done. How you get it done, we don't care. Just make the numbers. Is that the message that they're sending? Are there poor communication channels? Is there, for example, is there a whistleblowing program in place? So if employees feel that unethical behavior is taking place or undue demand and pressures being placed on them, do they have an outlet that they can go to in a safe kind of environment? And then committing to aggressive or unrealistic forecasts. We talked about that as well. That creates the management rationalize, well, everyone's doing it kind of thing. We have to make these numbers. If we don't make these numbers, then our stockholders suffer. This is the right thing to do for our stockholders, that kind of attitude. So we'll talk about these in more detail when we cover fraud. But the fraud triangle serves as a framework for auditors to assess fraud risk in a company and the impact that it could have on for material misstatements, potential material misstatements. So remember, AS 12 talks about the standards, the procedures that auditors should follow in terms of risk assessment, whereas AS 13 talks about the auditor's response to the risk assessment. So here the auditors are going to assess the risk of material misstatement at the financial statement and assertion levels, right? So remember, management makes assertions about items in the financial statements. So the financial statement level risk, and look at whether or not do these risks relate pervasively throughout the financial statements, because if they do, you want to develop an overall risk plan. So that means it's a pervasive problem. It doesn't matter what the assertion level is. If the answer is no, you look at whether or not, determine what can go wrong at the account or assertion level. And that's a part of what goes on as well in this brainstorming session via SAS 99. It's for everyone to kind of get together. And remember, we audit in cycles. So we look at the revenue process, the expenditure process, and the assertions related to each of those. So if the auditor determines that it's not a pervasive problem, then let's look at what could go wrong at the assertion level and then design the audit procedures at the appropriate levels, at the assertion level. In terms of that's the audit procedures represents the auditor's response to risk. Okay, so they have to design and implement audit procedures that address the risk of material misstatement. So again, think back to your audit risk model. And how you assess inherent risk and control risk drives the amount of evidence that you're going to collect. The important thing is, remember that it has to be an appropriate assignment of responsibilities. So you have to be able to appropriately identify your risk and then just determine who is the appropriate level to have addressed these issues or audit these accounts. So in other words, you're not going to have a first-year person auditing, fair value, assessing complex fair value models. And in some cases, you might not have a partner or manager doing it if it is outside of their expertise. That might mean that they have to go and hire an expert, right, if they don't have the expertise. But the point is recognizing where the risk is and then responding to that with the appropriate level of individuals on the audit engagement. Because, again, remember, do professional care. Also, supervision is extremely important. Again, SAS 99 talks about getting together, brainstorming, the code. You have to have a review. You're on an audit team. There are various levels of expertise and knowledge. The team, there's a review and a feedback process. So partners are reviewing it. We also, all firms have second partner reviews as well. So you have somebody who's not involved in the engagement on a day-to-day basis. They're not the engagement partner. So that's a part of the quality control of the audit as well, audit engagement, right? Because that person is not, an engagement partner might need more vested in that client. So somebody who is a second partner kind of takes a step back and looks at it from a higher level. and just to make sure that the audit, they've done the right things. They've dotted all the I's and crossed all the T's in accordance with not only firm policies and procedures, but in accordance with generally accepted auditing standards, or PCAOB requirements. The important thing also is not to do the same audit over and over, right? We talked about, when we talked about independence, we talked about in publicly held companies, audit partners have to roll off. Right? Part of that too is obviously from an independence perspective. You don't want your client or professional skepticism, objectivity, integrity. You don't want your audit partner to get so entrenched with the client that they're not as objective or as skeptical as they would be. When you have a new partner roll on, it gives this fresh pair of eyes kind of perspective to the audit. Also, the other thing we talked about with independence was that auditors, if they leave to go to the client, they have to have a 1-year cooling off period. And the reason is because that person knows the audit. They know what questions you're going to ask. They know your materiality limits. They know your risk assessment procedures. Right? They know what your risk, audit risk level is. So you want to have some unpredictability in the audit, even if the person isn't rolling off, just so that your client doesn't because your client can figure it out after. They know what questions you ask. You know, if you've been on that client. I think I read something recently that for the publicly held clients, the big 4 firms, I think the average audit tenure was like 22 years or something. Do you read that? It was. I think that's the number. It was really high. It was a long audit tenure, and a part of this is also another thing that the PCAOB has on their agenda. I think I mentioned this before. They're looking at rotating audit firms because they're contending that if firms have to rotate off, it would increase auditor independence, their objectivity, their integrity, and professional skepticism, because they're not going to be as entrenched in the client. Right? They're not going to become as reliant. They know that those audit fees are going to end. So they're not as concerned with trying to keep the client and keep the audit fees going for an unlimited amount of time. And also, it's really important for the auditor, again, as a part of this response, is understanding what the significant accounting principles are for that organization, and then ensuring that they're being applied in the context of the standard itself, GAAP. Determine whether or not they have to change their approach and their timing and the nature of their audit. So generally, testing of internal controls will happen during an interim period. But if you assess that controls are not necessarily, as you're doing the testing, you're probably going to want to going forward, look at controls closer to the balance sheet date or closer to the financial statement date, and not test it at interim. So an auditor is going to always have to kind of reassess the timing of when they perform their audits. And then we talked about professional skepticism. I can't stress it enough. It's important for auditors to always come with a questioning mind and a critical assessment of, and that's what's going to be key, really, as you're assessing inherent risk and control risk, because those factors are very subjective, right? So it's important for auditors to have a very questioning mind and make a critical assessment of the information and evidence that management is providing them with. Also, they want to, in designing the audit procedures, we talked about evidence, and it's important that you evaluate what's persuasive evidence. How well can you rely? You want the evidence to be reliable and relevant. And so you have to be, before you can decide what is the right amount of evidence, you have to understand the transaction. You have to understand the nature of the transaction. So you could imagine some things are pretty straightforward. Do I have a sales invoice? A vendor invoice? Okay. Do I have a shipping document? And given that I've determined that I can rely on internal controls, I can rely on the shipping document. So some things, do I have a bank statement? Right? Some things are pretty easy, you know, in terms to establish the relevance and the reliability. Some things are not. So we think about accounting estimates being a big, one big thing, where there's a lot of subjectivity and judgment involved in that process. How do you go about determining that the information or evidence is persuasive enough and that it's reliable? Keep going back to fair value, where there isn't a ready market. How do you test it? An auditor has to know up front that that's a risk. That increases inherent risk because of the complexity of that. And so they have to know up front, how am I going to respond to the risk? What kind of evidence is going to be relevant, reliable, sufficient, and competent evidence? So they have to assess that up front. Thinking about the types of potential misstatements. And again, that comes from understanding the client's transactions in their businesses. Where can the misstatement occur and what kind of misstatement? So if the client doesn't have effective internal controls over shipping, then what you expect that your misstatements are going to occur in the revenue process. You're going to expect to see that if they're going to be misstatements, we're probably going to see a higher risk of misstatements in revenue. So it's important to understand that and understand where the types of potential misstatements, the magnitude of those misstatements, and where they're likely to occur. And then obviously testing internal controls. You're only going to test internal controls, obviously, if you can rely on internal controls. If an auditor assesses that they can rely on internal controls, they'll test it. If you can't rely on internal controls, there's no point in testing it. But again, auditor has to determine that up front. I want to just briefly touch on engagement risk. So engagement risk is a little bit different. So whereas audit risk, or acceptable audit risk is what the auditor is the risk the auditor is willing to accept that they issue an incorrect report. Engagement risk is if the auditor does issue an incorrect report or it's perceived that they haven't done their job, right? Engagement risk is their exposure to loss, so through lawsuits, as well as the damage to their professional reputation. I don't need to remind you what happened after Enron to Anderson. There's no longer a firm called Arthur Anderson. So whether you argue hindsight that the government might have acted a little too quickly, who knows? The fact is, Anderson is no longer around. Okay. Also, there's research that shows that if a firm has been sued or there's some major lawsuit regarding an audit failure, that it has it can have a negative impact on their remaining clients, because that's because their reputation has been damaged. They've suffered a reputational loss, and that could cause clients to leave them. So even before Anderson went out of business, when Enron and WorldCom broke, clients started to leave Anderson because they didn't want to be associated with a firm that had that type of reputation. Not all their clients, but a lot of their clients started to leave. So engagement risk is the auditor's exposure to loss and professional damage to their reputation. And so obviously it's a negative impact. And it largely comes from client lawsuits, the clients can sue their lawsuits, or third-party lawsuits, or SEC actions, or PCAOB actions against the auditors. It's closely related to the client's business risk. The auditor uses it or decides their engagement risk and uses the risk to modify their acceptable audit risk. Again, these are all things that are unique to the auditor. This is not something that the client decides or the auditor shares with the client. These are the types of business decisions that the auditor has to make for each engagement. The factors affecting their acceptable audit risk was the degree we talked about, and you saw this in Pinnacle. So in Pinnacle, you had to answer these questions based on what's the degree of use by external users, how are they relying on the financial statement, so is it a publicly held company? Obviously that increases engagement risk. Engagement risk is normally higher when it's a publicly held company. Is it a company where you're doing an audit for a bank, for example, for a lender? Is it an initial public offering? Right? That is even more risk. The likelihood that the client will have financial difficulties, and then finally the auditor's evaluation of management's integrity. So those are all of the things that affect acceptable audit risk. So, before we break, let's talk. So the important takeaways here, as you're reviewing this chapter, it's not going to be an exam, but when you do review it, is understand materiality. And I'm going to go through a few problems next week to just talk a bit more about materiality. Understand the relationship between materiality and the audit risk model, right, and how those two are related. Understand the components of the audit risk model and how they're related, and how those components impact your audit evidence collection. Because what you're concerned with, the audit risk model is the auditor's way of assessing risk and then determining the amount of evidence they have to collect to respond to that risk, and then obviously designing the audit procedures to appropriately respond to the audit risk. And that's when we talked about the assertions, we talked about the assertions that management makes, and then the audit-related objectives for each of those assertions that leads to the audit procedures that the auditors are going to establish. That's their audit approach.